Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now, a happy man, Daniel Pinto, JPMorgan Chase President. Daniel, it's good to see you, sir.
Thank you for inviting me. It's great to be here.
Do you feel happy? Do you feel lighter now you know you're stepping down and retiring?
I do a bit. I've been in the company for more than 40 years. I add my contribution to the success of the company. The company is in an amazing place at the moment, and it's the right time to embrace the next generation, to work with Jamie and prepare the company for the future and his succession. So I feel good about the opportunities this company gave me, my contribution, and looking forward to a better balanced life going forward.
You are living the life that we all aspire to. Why now? And what do you expect the next 12 to 18 months to look like?
So it's very simple. This is being planned for a long period of time. And now is the time for me to transition in a very, very smooth way. This transition will go over a couple of years. My job will be to help the management team to continue advising Jamie and the board in issues that are strategic and important for JPMorgan and for the future of the company. So it is the right time. It is the right group that I helped Jamie to build up to. So I think that I feel good about where the company is and where I am now.
You've been at JPMorgan and its affiliate banks for 4 decades.
Yes.
It's a long time. You've been to a lot of Davoses. You've seen a lot of different cycles of enthusiasm. How enthusiastic is the optimism around the deal making and some of the mergers and acquisitions that could come down the pike?
I think that is quite enthusiastic. It was 24 was a very good year too. So you think about the M&A, the historical average of volumes around 4 trillion a year. In 2023, it was around 3.2. Last year, 3.5. We think that this year could get to around 4 trillion, which is historical average. And most important, we hope that the timing, particularly in the U.S., to approve transactions is not as long. It's moved from 6 months in the past to around 18 months. Hopefully, we could go back. It's not just to announce new deals, also to close new deals. And the environment is set for that.
Well, let's talk about the environment. Is it just the regulatory shift that we need, or do you find that 4%, 5% interest rates have held people back as well?
I think that if you think about the U.S. economy, has grown very well in 24, over 3%. It's likely to grow over 2% this year. So the environment is good. I think that even that is an economy that you don't see imbalances that tell you that it's an economy that is about to go into recession. This cycle could continue for a period of time. There is plenty of monetization that needs to be done in the sponsor space. There is essentially the valuations in the U.S. that are much higher than any other places. It's also incentivizing merging into U.S. companies. So I think that it will be a good environment.
We spoke to one bank yesterday who suggested that maybe these U.S. companies could go on a bit of a shopping spree in places like Europe where valuations were depressed. Are you engaged in any active conversations right now in companies looking to do those kind of things?
So we are always engaged with clients all over the world, and there is a lot of optimism everywhere about what the U.S. could do. So therefore, yes, there is dialogue everywhere.
So everyone sounds very optimistic, and then you go to some of these soirees in the evening, and people say there's a lot of enthusiasm. What actually will get done? We're less clear on, just simply because there is that question mark, to John's point, about benchmark rates, about the fact that the economy isn't slowing down so much. So why would they go any lower? And what happens if they go higher still because of debt and deficit?
I tell you how I think about it. When you think about the U.S. economy, it's in a good place. There are no imbalances. Consumer is in a good place. The corporate sector is in a good place. Inflation hasn't yet got to the levels that it should be, and the deficit is high. And then you have policies coming from immigration policies, tariffs, fiscal policies, and others. So at the end, this government is about growth. So therefore, I hope they will balance the implementation of those policies in a way that it doesn't either overheat the economy or triggers a recession. So I think that the hope is because of that, because the economy is in a good place and certain things like rational regulation, I don't like to talk about deregulation, rational regulation in our sector, in any other sector, could be good for growth. But if things go too far, then the Fed may have to hike rates and deal with inflation. Hopefully it doesn't happen.
I guess that what I'm getting at, some people are asking, what could potentially derail this optimism? Is there anything that you could see derailing this optimism this year at a time when people are basically counting on this sort of rational regulation or some of the other pro-growth measures?
To an extent is what I said, like inflation could be. That economy goes a bit too fast and doesn't allow inflation to come down. The geopolitical space is still in a challenging place, though there is some signs of potential improvement there. And at the end is like any other policy. You can do the right amount, you can do too much or too little. Hopefully the right amount is done in a way that doesn't derail an economy that is not ready for a recession. It's an economy that is ready to continue to grow at a decent pace.
Daniel, a lot's changed in your banking career, a tremendous amount, and now a bunch of alternative asset managers are looking for the activity that traditionally was on a bank balance sheet. Can you walk us through, as you depart, how different banking might look in the years ahead compared to when you first started?
Well, it's very different. I think that is in a better place with more scale, better quality of service, a better quality of products, and a safer industry that probably has ever been. I think that if you are referring to private credit, I think that banks, we've been lending for 200 years, and private credit is no more than a normal loan. So I think that we feel very good and where we are in order to compete in that space. And at the end, so what is our objective? To be able to provide the best possible service to a client. So therefore, what is it? Is in a certain transaction, you will be able to offer a syndicated facility, or you will be able to offer a direct lending facility. Both markets will tend to converge some way or the other, and we are in an amazing position to compete because we do have relationship with all those clients, and we offer to them not just the loan, we offer to them a bunch of activities.
We saw a relationship develop between Mark Rowan's Apollo and Jane Fraser's Citi, announced at the end of last year. Are you exploring similar partnerships?
We have plenty of partnerships, several, where we have co-lending facilities with other asset managers and that they want to participate in the origination. The issue for all these funds at the moment is that they are getting a huge amount of inflows and there may not be enough assets to deploy. So therefore, to have a partnership with someone like us or Citi or any other to be able to participate in the origination of these banks is a good thing. We are doing the same, not just with one, with as many as we can.
That kind of dynamic gets people worried. Not to be negative Nelly here, but you know, I'm going to the worries. But going forward,
Daniel's familiar with that.
I realize that I'm sounding pretty negative, but I'm wondering, given how much the flows have come in to the private credit sphere and how they've been searching for ways to be deployed, is there anything that makes you nervous within this ecosystem that's grown up very quickly?
At the moment, no. I think that when you look at these funds, they don't have too much leverage. They are leveraged 1.5 times. So from that point of view, particularly in the bigger space, bigger loans, not so much. The only thing that made me pause and think about it is there is a lot of direct lending going into small business. There is a lot of direct lending going into the smaller side of middle markets. And this industry in the current form hasn't been tested through a downturn cycle, because when COVID happened, it was all subsidized by the different governments. So how these funds are going to behave in a downturn with small business is something that you want to be concerned about it, you want to keep an eye on. But I don't think that there is a systemic issue in this space in the short term. The components are not there for that to happen.
Daniel, final question. How's the golf game?
It's okay.
What are we down to?
It's been deteriorating and hopefully will improve.
What's the handicap now?
It has gone from 5 to 8.
5 to 8.
Hopefully I go back
Get
to
it back
5.
down. You've got some time to do it now. Daniel, appreciate your time, sir.
No,
and congratulations on a fantastic career. Now I can do a more formal introduction to the former US Secretary of State, John Kerry, also co-executive chair of Galvanize Climate Solutions. Secretary Kerry, good to see you, sir.
Glad to be here.
We'll start again. I'll be more upbeat. I'm happy to see you. You know I am.
Thank you, sir.
The new president says drill, baby, drill. I want to understand how you feel about that and what kind of trajectory you think we might be going on through the next 4 years.
Well, I think the president's correct that we need an abundance of what we call firm energy. We need to make sure that America is leading in the technologies of this transition to new energy, clean energy. But I would say that build, baby, build is, drill, baby, drill ought to be replaced by build, baby, build, because that's what we need to do in all aspects of energy. There will be higher demand. He's absolutely correct, and I'm glad to see a $500 billion infrastructure announced, because that's going to be the key to our doing it, and it's going to be the key to leading in AI. But, and there's a huge but, data centers demand a massive amount of energy, and that's going to become very competitive. Will that energy be provided by clean energy, or is it going to just add to the problem we have of a warming planet with increased intensity to our storms, more damage all around the world? We haven't suddenly lost the connection between the choices we make about how we provide energy and its impact just because we elected a new president. So we've got to stay tuned into the science. We have to stay tuned into the marketplace, and the marketplace is going to move predominantly in the direction of this new energy. To wit, last year, about almost $2 trillion went into venture capital for new energy, clean energy systems. $1 trillion went into fossil fuel. That's a 2-to-1, first time ever shift in the marketplace. And if you look at what's happening in that marketplace, other technologies are coming on, like wind. Texas, the home of fossil fuels in America, that is now the leading state for the deployment of wind turbines. So I think the marketplace is going to continue to invest and move in this direction on a global basis.
Is that the marketplace or government intervention?
No, that's the marketplace. It's happening all around the world. I mean, I've been recently in the Far East, in Singapore, and recently also in the Middle East, in most of the Middle Eastern countries. Everyone is engaged in this transition. UAE, a major producer of oil and gas, is also a major producer of new nuclear plants. They've got 4 new nuclear plants. They have a vast array of solar, one of the largest fields in the world, and they are determined to have a higher level of energy produced by renewable energy.
But to build on what John is talking about, I'm thinking about, let's say, the electric vehicle credits. And there was this idea that we would really transition people to vehicles that were considered cleaner. And yet China did it successfully because they have the resources to do that. The United States doesn't. They need to import them, and it actually makes the U.S. more dependent on other places. Were some of the government policies misguided in what was necessary to actually tackle the problem from an economic perspective?
I think we worked very hard to open up new supply chains, and we did open up new supply chains. India is an example. We invested about $500 million in trying to build, in building the largest production plant in the world. And yes, China has, in fact, captured much of that market. And they captured it, frankly, with unfair trade practices, which is one of the reasons that's a legitimate issue between us and them. And we have to work that out. Solar was really worked on and developed by the United States and Germany. And then China stepped in. There was a massive amount of dumping into our country, and the production gravitated towards China. But today, China is now, many people complain, including the president. The president said China is not doing what it should be doing. Well, China is the largest producer of oil, of renewable energy, and deployer of renewable energy anywhere in the world, including more than all the rest of the world put together. So China is now commanding the market just by virtue of its production level. We need to get into that and compete.
But it raises this question: national security versus cleaner energy. It kind of pits two of your babies together. You know, it sort of raises this question: which do you prioritize?
The climate crisis is a national security crisis. The fact is there are about 39 million people wandering around Africa, elsewhere, trying to knock on the door of places where they think they can live because they can't live there anymore. They can't produce the food anymore. It's getting too hot. You can't work outdoors. So that's going to increase. That challenge, we had about 1 million people come in from the desert into Damascus, which changed the dynamic of the Arab Spring and of the war in Syria. So there's a linkage. What happens when water starts being reduced in its spread? What happens when the food basket of Africa implodes because they can't grow it anymore? These are real threats that smart people are spending a lot of time analyzing and understanding. And within the Pentagon, the Pentagon has called the climate crisis a threat multiplier. It presents serious challenges to all of us, and we need to treat it like the security issue that it really is.
But you understand, to Lisa's point, that we have become more dependent on an adversary, on China, for all the reasons that you describe. And yet we have some of these critical minerals, these resources within the United States. I'm sure you're familiar with the Resolution copper deposit that Rio's explored. It's ready to go, can support 25% of the copper demands of the United States of America, and yet for some reason it's been dragging along and hasn't been greenlit in the way that it should be. Why haven't we done that?
We have a problem in the United States, which I hope will be cured. It's a bipartisan challenge. We need Republicans and Democrats alike to come together in order to do permitting reform. We have 2,000 gigawatts, a huge amount of energy, almost as much as China has today. We have that backed up at FERC, the Federal Energy Regulatory Commission. That has not been approved over these years. Why? Politics. And so I hope we're going to get the politics out of the way, and I think President Trump understands that. That is a way to accelerate the deployment of the energy that he has now said we need.
Why do you think that didn't happen under a Democratic president with a Democratic Congress?
Politics. Why didn't the immigration bill...
Democratic politics.
Why didn't the immigration bill that had been put together with, Senator Langford from Oklahoma, he worked hard at that. It was bipartisan. It was ready to be passed, and President Trump, then former President Trump, called up and said, don't pass this. It'll help the Democrats. It'll help the Biden administration look good.
Do you think
I don't
the
want
Democrats
to get involved
themselves?
Look, I'm not here
You started this conversation. Do you think they helped themselves over the last 4 years? The Democrats over the last 4 years. Did the party help themselves?
I think there were serious questions about the message and so forth, but I'm not here to be political. I'm here to talk about the energy crisis.
Isn't there something very political about this crisis, though? It is by its very nature political.
It seems to have been weaponized. And unfortunately, that's a loss for all Americans. For instance, if you decide, as President has, to pull out of Paris, we are not at the table. We lose the leverage of being at the table. We lose the protection of our country in terms of something that might be passed or not passed by not being at the table. Moreover, last time he pulled out, there was only one person in the entire world, of all the leaders in the world, that pulled out of the Paris Agreement. And by the way, the Paris Agreement was still implemented in the United States because we have 37 governors who implement renewable portfolio laws, and they did that. We had over 1,000 mayors join into something called the We're Still In movement, and that's exactly what's going to happen now. And by the way, and this Bloomberg obviously understands better than anybody, the power of the marketplace is what is going to make determinations here. Oil is a commodity, and it hasn't really changed much in price for over 100 years. But technology is what is really driving these changes that are taking place. And I think rather than being driven by commodity prices, this revolution is going to be driven by technology prices, which are now lower than the prices of fossil fuel.
You've been a big proponent of not exceeding this 1.5 degree increase in the global climate. You've said that you think we're going to blow past it. You're working with Tom Steyer of Galvanize to try to raise money. There's been a huge vibe shift away from ESG where people are saying, well, if we can't solve it, whatever. Yeah. How do you sort of see the enthusiasm to invest in things that have been highly politicized, that have been weaponized?
That is a great question, and I'm really glad you asked it because it's central to what we're doing. Nothing that we're doing is based on reliance on the government to do something or reliance on a subsidy of some kind. We're not in there to find or to be the source of concessionary funding or to find the concessionary funding. We are investing in portfolio companies that have the ability to affect this transition just on basic fundamentals of business, just looking at the marketplace. And we will show people how, in fact, and there are other companies doing this now, how this transition will allow you to invest and make money. And you will be able to make better returns than some other things that are out there today. That's the basis of this investing. And when the market sees the way that a whole bunch of people are, in fact, turning this around, making money. AI is going to be a big part of this. Geothermal may be a part of it. But you need an all-of-the-above investment effort now because the science is telling us we have to move faster. And ultimately, that demand is going to change people's attitude about this. You know, electric vehicles grew by 5-fold last year in sales. Solar grew by about 4-fold last year. Solar has now had a 60% reduction in price. So whereas oil is affected by the economy as a commodity, the renewable portfolios are going to be affected by the technology change, which is lowering their costs. Yep. And I'll tell you what, right now, there is no question but that the reduction in price of wind and solar and the new fibers that's available to transmit higher levels of energy at much lower cost, all of these things are coming together to say it is cheaper. 1.7 cents per kilowatt hour in some contracts that are being let now on solar. So I think the marketplace is going to make this decision, and no one person.
You'll forgive me for jumping in because we're up against the clock, sir, but I just wanted to fit in one final question because your voice is important on this issue. Are you encouraged by recent developments in the Middle East and the agreement struck between Hamas and Israel?
Well, obviously, I think it's great that we've got an agreement that a lot of people worked extremely hard on for some period of time. Things are always tentative and difficult in that part of the world. A lot will depend on the government of Israel and how it approaches the future. I saw a debate this morning on TV about the meaning of the West Bank, and if efforts are made, I think, to move to the sort of greater Samaria, Judea-Samaria philosophy without resolving what's going to happen in the long-term governance, it's going to be a real problem. So hopefully wiser heads will prevail and people will move forward. But you have to begin to build building blocks. This is the first step. Yep. Build a little confidence. Make some things happen. But then hopefully have a shared vision for the long-term future of Gaza and of the West Bank, and obviously for Israel's security, which is paramount. You've got to be able to resolve that as you move forward.
I think we all share that hope. Thanks for being with us, sir. Appreciate your time, as always.
Glad to be here with you. Thank
John
you.
Kerry there, the former U.S. Secretary of State. Joining us now to discuss is the Guggenheim CIO, Anne Walsh. Anne, it's good to see you.
Good morning.
Welcome to the studio. Let's talk about it. The salespeople running around Davos trying to sell, saying things are really good in America right now and they could get even better. You've got to put money to work, and we're already priced for a lot of that. How challenging is it for you and the team?
Well, it is an interesting time. You've got rates that are range-bound. The 10-year trading between, we'll call it 375 and 475. You have credit spreads that are tight relative to history, and you have stocks that are stretched in valuation relative to expectations and at a risk premium that is less than zero. So it can be very tricky at this particular juncture, but fundamentals remain pretty strong, and so there's opportunity for investment in maybe a wide array of selections and sectors. So there's things to invest in.
I remember this sort of pendulum switching from bonds to stocks, people saying that stocks really seem like the dynamic place to be in a pro-growth administration at a time where inflation hasn't completely gone down. Do you agree with that stocks are preferable to bonds at a time where really growth is the main theme?
Well, I think that does give a lift to stocks, and as long as earnings per share projections turn out to be accurate, I think that there's still room for opportunity in equities. However, we also have to remember that not all markets are exactly the same. So if you look at the Russell 2000, you still have a very high percentage, around 40%, that are non-earners, and the Mag 7, of course, is well below risk premium levels that we've seen not since the late 1990s, where we had negative risk premiums. So I think that we have some risk associated with the market, that it is priced for perfection. So I would be cautious, but cautiously optimistic. And as long as, and we still see earnings per share rising, maybe not at the level that is priced into the S&P right now at 15% earnings per share growth, but nonetheless, still a fairly positive environment.
Stocks are priced to perfection, in your view. Are bonds priced to perfection?
No, actually, I think there's some real opportunities in fixed income still. We have a risk premium that's positive relative to, certainly relative to equities. And also, you're getting a real rate of return that is much better than we had pre-COVID. And you're getting a nominal rate of return in any number of areas that make a lot of sense. So we like all sorts of credit stories: structured credit, corporate credit, even high yield, and particularly the high quality portion of the high yield market. So there's still some real fundamental value that can be found in fixed income.
Can you say the same thing about treasuries?
Well, like I said, we're range-bound in treasuries, and there's a trade that's actionable there as we go up towards the top end of the range, in the high fours, if you will, 475. You can extend duration. You can then also, as we move back, shorten. After all, we saw a 120 basis point rise in the 10-year, and we were able to play that trajectory really quite nimbly, if you will, during that window of time.
The incoming government might have to look at extending duration as well. Will that complicate things? How do you think about the deficit concerns of the moment, and do you think that's been responsible for the pickup in yields we've seen through December and into the new year?
I think there's a couple things that have really influenced the rise in rates. One is the deficit, and it's a real concern. Who's going to buy all these bonds that we have to issue in the U.S.? Right now, we're still being able to be financed through both U.S. investors as well as international investors. So that story is still playing out pretty well. But at the same time, you also have a Fed that is sending mixed signals with regard to the rate trajectory. Now, our belief is that rates are still going to be moving down over the course of 2025, and we're going to move towards a neutral rate. And I think it's going to be tricky for the Fed to really find that perfect neutral rate. But at the same time, they are also still slowly reducing their balance sheet. So they're sending mixed messages, and they're also acting in mixed ways.
You know, John alluded to this idea that the U.S. has to finance all of this, and you were mentioning this, right? Where's the money going to actually come from? And we've talked about how that sucking sound of cash going into the United States to try to fuel this, crowding out some of the debt issuance and other assets in other regions. How destabilizing is it to have one economy accelerating so quickly and diverging from the rest of the world?
Well, it is unusual, but what I would also say is that because the strength of the U.S. economy has definitely been there, we continue to see an inflow of capital, and I think we're going to continue to see that. And the opportunity for investment is going to go beyond the markets necessarily and into infrastructure investment, manufacturing build-out, real estate.
For the U.S.
For the U.S.
But not for the rest of the world.
But not for the rest of the world so much. And so there's going to have to be some real balance there. But for the meantime, the U.S. is going to continue to attract capital.
Can we get you excited about Europe in any way, shape or form? We're sitting here in Switzerland.
It's beautiful.
It's beautiful. A lot of people say it's a great place for a vacation. I've always been told that by US-based investors. Can we get you excited about Europe at all?
I think that Europe has some real opportunity, but they have to really make some structural changes. And we'll see if Europe's able to do that. One of the areas of maybe concern or caution is that previously very stable governments are seeing some turmoil. France Germany, elections coming up. And so I think that as we come through those and we see more evidence of the trajectory, and if we see a real desire for Europe to engage in structural reforms, then I think we might be able to see an investable opportunity.
There's a lot to fix, and I appreciate your time. As always, it's good to see you. Anne Walsh there, the Guggenheim CIO. Lots of changes overnight on the trade front once again. Lots of threats that we can explore with the former US House Speaker, Paul Ryan. Speaker Ryan, it's good to see you, sir.
Hey, good to be with you.
Let's think about the ideology of the sitting president. What is the ideology? What's your familiarity with the ideology around things like trade?
I think the best way to describe it is America First. I think he's articulated an America First. On trade, it's a little more mercantilistic, say, than the traditional Republican, Reagan free trade. But America First is the quickest way of describing it. A lot of good fiscal policy, regulatory policy, tax policy. There's a lot of optimism, frankly. But on trade, I mean, I'm sure you have an international audience here. There's going to be some trade friction, no two ways about it.
Without a doubt. How do you feel about the mercantilists taking over the Republican Party? Was that the right step?
Well, there's different kinds of Republicans. I'm a classical liberal, free market, free trade Republican. So I'm a different breed of a Republican. His breed of populist Trump Republican is the ascendant breed. They're basically the dominant force in the Republican Party. Donald Trump is the dominant force of the Republican Party, no two ways about it. But we have a coalition that is playing nice with each other right now. And frankly, I'm optimistic on a lot of policies that are coming together. And all of those policies will not happen if you have Republican disunity. So I think it's very important that Republicans stay unified. The executive branch has an enormous amount of power when it comes to trade policy. That's something that 100 years ago Congress ceded to the White House. But on all this other fiscal policy, Congress has a huge role to play. And it's really important that Republicans stay unified with these razor-thin majorities we have.
One of the initiatives that they need to deal with is the deficit. And I'm focused very much on the bond markets, and I'm sure you are too, as a free market Republican. And I just wonder how much conviction you really see in both camps of the Republican Party, as you just laid out, to truly combat some of the deficit concerns that we feel here at Davos.
There are definitely deficit hawks in Congress, no two ways about it. The people running the various committees in charge of this, the Budget Committee, the Ways and Means Committee, the Finance Committee, they are deficit hawks. So first of all, you can't do well on your debt servicing if you don't have nominal GDP growth outpacing your debt servicing costs. So number one, fast economic growth is paramount. That's why this deregulation is very necessary. That's why extending tax reform is necessary. We don't want to hit the economy with a wet blanket like Biden did with the promise of higher taxes and more regulations. Really important. On the debt, the only way to get the debt under control is to do entitlement reform. That's more of a comprehensive thing. That's what I spent most of my time in Congress working on. I think there's a way to do it. The most bipartisan solution that's out there right now are these fiscal commissions. There's a lot of talk about that. It wouldn't surprise me if Congress acted in a bipartisan way on a fiscal commission, not like Will Simpson, which I served on, but one with teeth that requires action. That's probably the biggest talk in town right now about real debt reduction. But in reconciliation, who knows? You could see some debt reduction occur there, too.
We've already heard, though, from this administration. They're not going to cut Social Security. They're not going to cut Medicare. They're not going to cut any of those entitlements that they really want to cut. And I just wonder...
Well, I wouldn't say they really want to cut.
Well, I'm just
that's
saying,
not the way to say it. Everybody who ran for president lately has been saying we're not touching these things. I don't agree with that. I'm a different,
but
like I said, a different breed of Republican.
Do you think that it's going to hit the wall, that there's going to be a real challenge that undermines some of the optimism that we're hearing here?
Well, within a decade, you have both the Medicare Part A trust fund and the Social Security trust fund going bankrupt and insolvent. So you have to do something about that. You've got to step in front of that. By the way, you don't need to cut these programs to fix this. You can grow them a little more slowly. You can reform these programs. And you can do it on a prospective way so that you don't affect people in or near retirement, but do it for the younger generation, like my X generation. So there are good reforms out there that I think are politically palatable that move the needle on the debt tremendously. The question is whether or not, and by the way, if it were easy, we would have already done it. I passed 4 budgets in the House when I was budget chair that did this, but they meant nowhere in the Senate. So this is really hard to do.
Would you vote for an extension of the Tax Cuts and Jobs Act?
Absolutely.
Why does that make sense?
Because we want growth. If you don't do this, the kind of tax increases that are going to hit the economy, first of all, immediate expensing, R&D amortization, these are very important business tax relief. But what people who aren't Americans don't necessarily see is more than 2/3 of our businesses are not C corporations. They're pass-throughs, LLCs, subchapter S corporations, they pay their taxes as individuals. There's a massive tax increase on those businesses, the engine of job creation in America, if you let those things expire. So that's really important. It's this thing we call Section 199A. I don't want to get too deep in the details.
We haven't got time.
It's going to be bad for the economy if you let those tax cuts expire, so you do need to extend
Scott
those.
Bessent said the same thing. He said it could be an economic calamity. Could you describe that calamity for us? Just how bad?
I'd say about 80% of small businesses would have a massive tax increase, over 20% tax increase. And oh, by the way, you'll put them at a massive competitive disadvantage against corporations. Huge job dislocation, and most of our jobs come from small and medium businesses. You cannot hit those with a big tax increase.
You know how difficult it is to put together these bills. That's only one piece of the tax effort.
Yeah, I wrote the last one.
I know you did.
It was, and I had a 22-seat margin. Easier to play with the 22-seat margin.
They don't have those margins this time around. How difficult is it going to be to do anything above and beyond just extending?
This is why I say Republicans need to stay unified, because all of us agree on this type of fiscal policy. We may have different agreements on trade. We don't have disagreements on this. Really important that Republican factionalism doesn't occur. They stay unified and get this done. The country's counting on us. Donald Trump promised it. And one of the reasons why people are so optimistic is because they believe this is going to happen. At Teneo, we polled 700 CEOs representing $10 trillion of wealth, and it's a 32-point swing in optimism from last year to this year.
We've seen it
on the U.S. economy.
And I can tell you, Speaker Ryan, we hear it repeatedly every single hour.
That optimism has to be translated into policy for it to be realized, and that means pass this bill.
Speaker Ryan, thank you, sir.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.